Where is your dot for 2018? Do you think that 3 rates, as the median would have it next year, 3 rate increases is justified?
I think gradual and patient removal of accommodations justified. My dot actually was 3, which is right on the median. Will it turn out to be 3? I think time will tell. But I do think we should be removing accommodation in a gradual, patient way, and that's the key thing to me.
Well, how much of your forecast is based on the impact of tax cuts?
Modest. I've been saying up till a few weeks ago it didn't have any effect. And then over the last couple of weeks, we modestly firmed our 2018, 19, and 20. When I say we, the Dallas Fed. It created a little bit of firming for us in our GDP forecast and a little more aggressive overshoot of full employment, i.e. a lower unemployment rate. But I'd say the impact was on the margin, and a modest impact over the next 3 years.
And it doesn't seem to have any effect if you look at the Fed consensus on long-run potential growth.
Unfortunately, yeah, there's 2 parts of this tax bill. One of them I've been very positive about, which is to the extent you do corporate tax reform and you improve incentives to locate your business in the United States and invest in the United States, I think that could be positive on a sustainable basis. The part of the bill that's a tax cut financed by increase in the deficit will give us a short-term bump, a modest increase in the short run, then we'll tail back down to trend growth. And the issue is we'll be more highly leveraged at the end of it. And I already think that U.S. government debt to GDP is unsustainable, so it makes that issue worse.
Well, there's already a lot of talk out there about what and whether companies will do with the tax cut they get. Yeah. What are corporate CEOs telling you in your district about whether they're going to invest a lot more?
So there's not a CEO I talked to who didn't want the tax bill to pass, and for several reasons, but one of them, it's going to improve their after-tax earnings and earnings per share. The bigger question is, will it cause them to change their investment? And one thing you got to emphasize, corporate profits are at record levels, okay? The cost of capital, cost of debt, cost of equity is historically low. And so I would say most CEOs I talk to, a bulk of them, may not have any explicit impact on their investment. On the margin, it may be positive. It might, for those who are thinking about moving facilities offshore, it may cause them to be more likely to stay here. But I think the impact of it, understanding we're already near full employment or at or near full employment, we're already got record profits and capital is relatively inexpensive, means that the impact of this, when I talk to corporate CEOs, probably modest and on the margin.
Given all that, I'm curious. Kevin Brady, the chairman of the Ways and Means Committee who put all this together, is from Texas.
Yeah.
Did he consult with you or anybody at the Dallas Fed?
Listen, I think there was a lot of consultation, and we make our research widely available. And again, I do think over the long term, the corporate tax reform and improving incentives to locate your business here and invest here is a positive. The part of the bill that's a challenge is the part that's a tax cut that's financed by increasing debt to GDP. That's the challenge.
We were just talking in the news about the disaster plan. The House was talking about additional cash, talking about infrastructure plans. They're talking about additional spending for defense, plus the tax cut. All that goes on the country's credit card.
Yeah.
You are worried about debt. Will we see an immediate impact in 2018-19 on interest rates?
We may not, actually. I think the issue for us is debt held by the public of the U.S. government is about 75% of GDP. But the bigger issue is the present value of unfunded entitlements today is $49 trillion. Okay, we're going to start to see over the next 5 to 10 years that $49 trillion work its way into bigger and bigger budget deficits. If you look at the Congressional Budget Office 10-year report, you see budget deficits as a percentage of GDP are gradually rising. That's the issue, and those issues have to be addressed. And to the extent we further add to debt to GDP, it makes those issues even more difficult to address. My concern is not about the short run. It's in the longer run. Do we need to take actions that create a headwind for GDP in order to get the debt to GDP growth under control? That's the challenge for me.
Let's talk a little bit about the Fed going forward. A lot of questions being raised about the economic projections. For example, in 2017, the consensus is 2.5% growth, and the unemployment rate goes down 0.2. But in 2017, we had roughly 2.5% growth, and the unemployment rate went down 0.6. How do those square? So
here's how they square. And my own unemployment forecast is probably more aggressive than the median of the SEP. What people should expect will happen, even though we're going to have solid rates of growth, I believe, in 2018 and 2019, as we approach full employment. And even, you've heard me say, U6 in the lingo, which is unemployed plus discouraged workers plus people working part-time for economic reasons. That measures 8%, much higher than the 4.1. But the problem is that's at its pre-recession low. And I think what you're going to find, and people should expect, as we get at or near or overshoot full employment, job growth will slow somewhat, and the degree of reduction in unemployment rate may also slow somewhat. So I think that may explain why you're seeing a little slower rate of reduction in the unemployment rate.
Well, the other question is growth goes up, unemployment goes down, in your case more aggressively. Nothing happens with inflation. Why not?
So to me, you've got two competing forces I've talked a lot about. One is the cyclical pressures, and I'm confident there are more wage shortages, at least for skilled workers, and at the low end of wages, there's wage pressure. I'm not as certain about middle $20. If you make $20 or more, I'm not as sure, based on my discussions with businesses, that there's wage pressure. But the point is, cyclical forces are building, and as we take more slack out of the labor market, that will build more. Then you've got a headwind, which is technology-enabled disruption. Technology-enabled disruption, yes, means people being replaced by technology. It means consumers being able to shop more aggressively for the lowest price. Pricing power of businesses is limited, and it means new business models for selling and distributing goods. That is causing businesses to be very challenged in passing on wage increases into prices. And I think that structural force is intensifying. So you've got the cyclical, the structural, and I think that's creating a muting effect on inflation. And that's why at the Dallas Fed, we're doing a lot to try to study this phenomena. And we're holding a conference in spring, as you know, to try to encourage the system and academia and businesses to do much more to study this.
Why not then adopt the Charlie Evans approach and wait till you see inflation accelerate before you raise rates?
So here's why. I believe we should take a balanced approach to monetary policy. It means, we have a dual mandate, full employment and price stability, i.e. the 2% target. But we are already at or near full employment now. I believe we're going to overshoot full employment in the next year. I balance that against the fact that we're undershooting our inflation target, but it's not one or the other. I think you've got to balance the two, and the degree of the overshoot is such. My concern is if we wait too long to remove accommodation, we're going to be playing catch up, and the history of playing catch up by the Fed is not a happy one. The history when we overshoot full employment is that that tends to lead to a recession because the Fed has to play catch up and balances build, and so I think a more gradual, patient approach will serve us much better.
The yield curve, a lot of talk in the markets about that. One of your colleagues worries about inversion and recession in the coming year. What do you think?
I'm worried about it too, and I think we need to watch it. So the 10-year Treasury, high 230s, 240 is meaningful, and here's why. The history of inversions is such that it has tended to be a pretty reliable forward indicator of recession. Now, this time may be different, but I wouldn't count on it. And so with the Fed funds rate at 125 to 150, I can tell you I will be watching very carefully the 10-year Treasury as we go into 2018 because it limits the operating flexibility, in my judgment, for the Fed in terms of how much and how fast we can raise rates.
You're the Mexico expert on the Fed. Your district does a lot of business with Mexico. What do you think the odds of a NAFTA cancellation are? What would that do to the country's economy?
Well, let me start with the easy part of this. First of all, I'm hopeful because I think it's in the U.S.'s interest that we renegotiate NAFTA, and the trading relationship, I've been very consistent saying with Mexico, is very important strategically to the United States. Why is that? 70% of the goods we import from Mexico are intermediate goods, not final goods, intermediate goods. That means they're goods that are going back and forth across the border as part of integrated supply chains and logistical relationships that our research shows makes U.S. companies more competitive and adds U.S. jobs. So it's in the strategic interest of the United States, not just Mexico, that we keep this relationship. So I'm hopeful NAFTA will get modernized, updated, but these integrated supply chains allow us to add jobs in the United States. If we didn't have those relationships with Mexico, it's our own research that those jobs may on balance be lost elsewhere in the world, most likely to Asia. We need to increasingly think of the Northern Hemisphere, this hemisphere, as a competitive bloc where we're competing with Europe, we're competing with Asia. The trading relationship with Mexico allows this hemisphere to be more competitive and helps U.S. in our judgment at the Dallas Fed.